This is Macro Horizons, episode 374, Ides of May, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of May 18th. Fun fact, the Ides, in the Roman calendar, only fall on the 15th of the month in March, May, July, and October. For all other months, it's the 13th. Of course, it had to be the 13th. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, we had several key data events that, when taken in combination, reinforce the idea that the U.S. economy remains resilient, which will afford the FOMC plenty of time to wait and see how the war in Iran impacts the global economy as well as the U.S. economy. CPI came in up 0.6% on a month-over-month basis, and that was as anticipated. We also saw an increase in core CPI of 0.38%, which rounded up to 0.4%, but was really not particularly far off the consensus, which was for a 0.36 number. Overall, the details did show some moderation, particularly within core goods that was effectively flat, increasing just 0.03% on a month-over-month basis. That was the lowest in 4 months and followed March's relatively benign 0.1% gain. This is an important category because it demonstrates the lack of pass-through of higher tariffs to the end user on the core goods side. So from the Fed's perspective, this is clearly a welcome development. On the flip side, however, the supercore measure, which is core CPI services excluding rent and OER, increased to 0.45% versus the 0.18% in the prior month. So there clearly remain some sticky pockets of inflation that will serve to reinforce the prudence of the Fed's wait-and-see strategy. Nonetheless, this all combines to a core PCE estimate of 0.26%. So for April, the Fed's favorite inflation measure will increase by either a high 0.2 or a low 0.3. The week just passed also included April's retail sales figures, which increased in line with estimates, up 0.5%, with gasoline stations increasing 2.8% on the month versus the 13.7% gain seen in April. Energy prices continue to dictate the pace of spending in nominal terms. Recall that the retail sales figures are not inflation adjusted, and for a month in which headline inflation increased to 0.6%, the fact that we only saw a 0.5% increase in headline sales implies that in real terms, the U.S. consumer's purchasing power has been under pressure, to put it mildly. It will be interesting to see how the consumer performs over the summer months, particularly with driving season close at hand and gasoline prices clearly elevated with a bias to go even higher. On the employment side, the initial jobless claims print came in slightly higher than expected for the week of May 9th at 211,000. That is 6,000 more than the forecast and marks a bit of acceleration from the prior level of 199,000. With these marquee data releases now out of the way, the market is once again free to focus on developments in the Middle East and trade some of the headlines that are coming out of the summit between the U.S. and China. Our approach the week just passed was to come out of the refunding process with a long bias for duration, and as 10-year yields challenged 450 on Wednesday, we did see some dip buying interest emerge, and we expect that 450 will be a clear line in the sand, as it were, for at least the next week or two.
While it may not have originally been billed as a critical macro week for the Treasury market or financial markets more broadly, the aggregate of the new information that investors received over the past several trading days showed a more troubling than initially expected inflationary picture, with both CPI and PPI surprising on the upside in April as one of the first real looks on how the price action in oil after the start of the war in Iran is flowing through to the broader inflation complex. Now, of course, it's not new information that higher headline inflation is to be expected, but at bigger issue within April's data was the flow through to the core side of the equation, where we also saw a larger than expected increase in core CPI. As would be expected, bonds took this news in bearish fashion, with 10-year yields breaking 450 and a definitively bearish tone dictating the broader price action, as investors continue to grapple with what a more sustained higher oil price environment is going to mean, given that it appears there's no near-term resolution to the war in Iran on the horizon. That won't prevent headlines from driving some intraday volatility, but nonetheless, for the time being, it seems that it's status quo in the Persian Gulf.
And I do think that the CPI numbers came with a couple caveats worth reiterating. First, there was a catch-up or a bit of a payback in OER and rent. The OER and rent contribution was particularly large in April because this is the release at which the BLS decided to backfill some of the estimates that they put in place during the government shutdown. So there was always going to be a bit of an upward bias on the core CPI numbers. The other caveat is that within the data, we saw that core goods were effectively flat. So this means that as the Fed continues to wait for confirmation that the trade war-related tariff increases simply functioned as one-off price adjustments as opposed to driving demand-side inflation, this offered a bit of solace within the series. Of course, it is all about energy. It is all about the war in Iran and how that's going to flow through to core inflation. And so the fact that the market did respond upon bearishly follows intuitively. Although in translating the inflation series that we received this week towards core PCE estimates, core PCE, the Fed's favored measure of consumer price inflation, is expected to come in at a high 0.2 or a low 0.3, which, while not exactly at the Fed's objective, is lower than what we saw at the beginning of this year. So, on net, the price action in the Treasury market has been adequate to absorb the updates in fundamentals, while at the same time setting up the refunding auctions reasonably well. And while all three of the auctions, 3s, 10s, and 30s, did tail, the tails were less than a basis point each, and overall the auction process went reasonably well.
And away from the price action explicitly in treasuries, it was notable to see how risk assets responded to the higher-than-expected inflation reads and the increase in yields. Specifically, the S&P 500 set another record high, and broadly speaking, spread products, risk assets generally, continue to perform well, even with the risk-free rate now back to 4.5%. This matters for several reasons, the wealth effect and what it means for consumption being an obvious one, especially from the relatively strong departure point in terms of what we saw in Q1's growth data and a resilient consumption backdrop before the spike in oil and gas prices reaching $4.50 a gallon. And so equity performance, at least for upper income quartiles, will help offset the tax on consumption dynamic from prices at the pump. Additionally, it matters for financial conditions. Rallying stocks in a declining VIX, and frankly declining volatility across asset classes, all carry an easing impulse as it relates to financial conditions and represent the exact opposite of what would be expected by the increase in Treasury yields, which would be the market tightening for the Fed, when in fact, to look at the breakdown of some of the cross-market price action, financial conditions actually continue to remain very easy and take some of the onus off Warsh to cut sooner rather than later. Breaking down the move in yields over the past month, we actually see 10-year real yields are lower than where they started out April, and stocks are obviously higher. And so that means that the sell-off in treasuries has been a break-even story, which follows intuitively as inflation expectations have repriced to what oil has done. And so the combination of higher inflation expectations, lower real rates, and easier financial conditions advocate even more strongly for no urgency from the next cut, even if it still seems improbable that a hike is going to be warranted at this stage.
And we also learned this week that Warsh has been officially confirmed as the incoming Fed chair. So this means that June's meeting will be his first at the helm of the FOMC. Now, we're not expecting any fireworks or anything dramatic to come from his first meeting. He doesn't have the data to even think about beginning the process of laying the groundwork for a rate cut, regardless of what conversations he might have had with the administration regarding the forward path of policy rates. Instead, we expect that the focus will be on the FOMC statement and any shift to the forward guidance, especially in light of the recent 3 dissents in favor of taking out the modest dovish bias to the forward guidance. Now, Powell clearly advocated for keeping the forward guidance as is, and we suspect that that will probably be Warsh's baseline approach as well. Nonetheless, the transition comes at a point where the economic data continues to demonstrate resilience in the labor market, or at least stability, and pockets of pass-through from higher energy prices to the end user. The most obvious from the April CPI report was a significant increase in airfares, which is simply a function of jet fuel costs. So, with this backdrop, the market remains very much in the mode of trading each incremental headline out of the Middle East, and with the Strait of Hormuz still effectively closed, we expect that in the week ahead the market will refocus on trading the energy sector, with now the context of the performance of the real economy during the first 2 months of the war.
And away from what's going on in the Middle East, we also saw President Trump and several business leaders from the U.S. make their way to Beijing for the long-awaited meeting between Trump and Xi Jinping that was supposed to take place a few months ago, but was obviously delayed by the attacks on Iran. While it's too soon to say definitively what will come out of the meetings in China, from a broader perspective, let's not forget that the trade war remains ongoing. And as one of the Trump administration's favorite negotiating tools, the impact of tariffs in driving the White House's foreign policy agenda remains very much top of mind, even after the Supreme Court's ruling and what we know is the executive branch's pursuit of more creative solutions to getting tariffs implemented. The fact that the detrimental economic impact of tariffs and, frankly, inflationary impact of tariffs have not been as severe as initially feared means that any incremental softening in the rhetoric between Washington and Beijing and what that might mean for a lower tariff rate on both sides of the trade relationship means that going forward, the path is more likely toward less escalation as opposed to more, at least as it relates to import taxes, particularly at this point in the year, and as you mentioned, Ian, with an increasingly clear picture of how the economy is performing to this year's events so far. If in fact we do get a global positive growth outcome from Trump's visit to China, that would only represent another point of optimism for the domestic economy and the domestic consumer. Now, who knows what the next headline will ultimately say, but as something away from the Middle East to keep an eye on, it will be interesting to see any more lasting agreements or takeaways that comes out of the conversations in Beijing.
And from a flow perspective, it's interesting to observe that the Ministry of Finance in Japan published its weekly investor flows data and revealed that there has once again been an uptick in buying of overseas notes and bonds. While the weekly data doesn't break down between treasuries and other sovereign debt, historically the vast majority of flows have been, in fact, into U.S. treasuries. During the last week of April and the first week of May, flows combined to total roughly $26 billion. This is also notable because this period represents what is effectively the beginning of the Japanese fiscal new year. It also brought the 6-week moving average decidedly into positive territory for the first time this year. So putting this in the context of the perennial question, who's going to buy all of this treasury debt, it appears that Japanese investors are once again engaged in the market.
And the behavior of investors out of Tokyo is indicative of, at least anecdotally, the conversations we've had with real money clients in Asia and domestically. And that is that away from intraday trading or the more micro yield ranges that we've been tracking, 450 10s and 5% 30s have long been highlighted as the level where investors are more comfortable getting involved. It's not a new story, but it's one we hear extremely consistently in that there is still a massive amount of liquidity in the system that is in search of higher yields. And so, given what is still a large amount of sidelined cash, the fact that we're now back to levels that have so consistently been highlighted as buy targets We're expecting that any spread widening, either in IG or mortgages, or any further backup in outright yields in Treasury space from these levels will be increasingly short-lived and likely of a lesser magnitude. Said differently, we expect that market participants will be much quicker to buy the dip from 450 than they would have been from 425. This doesn't mean that a challenge of 465 or 470 tens is off the table, but we doubt the market will trade there for long.
All of this is very consistent with the adage that there's no such thing as a bad bond, just a bad price. Or bad bond salesperson. In the week ahead, the data calendar is remarkably limited. The releases of note include the weekly jobless figures on Thursday, as well as the weekly ADP figures on Tuesday. Aside from that, just a few updates on the housing sector, and of course, Wednesday's release of the FOMC minutes. As it pertains to the FOMC minutes for the April meeting, which was Powell's last, we'll be watching for any further detail on the degree of debate around whether or not to change the forward guidance within the statement. Recall that there were 4 dissents, 1 in favor of cutting rates and 3 in favor of removing some of the dovish tone within the forward guidance. Perhaps this was just an early message to Warsh from some of the hawks on the committee, as June will represent his first meeting at the helm of the FOMC. The week ahead also contains a couple supply events of note. On Wednesday afternoon, we have 16 billion 20 years that will be auctioned, and then on Thursday, we see 29 billion 10-year tips. As a theme, nominal Treasury auctions continue to go reasonably well. This despite the May refunding, which saw tails for new 10s and new 30s, as well as for the 3-year. We maintain that auction performance is as much about the prevailing volatility in the setup to the event as it is outright demand for Treasuries as an asset class. The larger issues still dictating the macro outlook have yet to be resolved, and those are primarily focused on the Strait of Hormuz and the risk that as producers work down inventory, that realized prices in the energy sector will be skewed higher in the coming months. It goes without saying that the longer the conflict persists and the longer the Strait of Hormuz remains effectively closed, the more upward pressure there will be on the energy sector and the higher the probability that the energy shock leads to a material downturn as producers and consumers struggle to grapple with the ramifications of higher energy prices. Aside from the FOMC minutes, there's not much in terms of official Fed commentary on the schedule for the week ahead. And frankly, given the consistency of the message that the Fed is going to be on hold for the foreseeable future, the absence of any further updates won't really be a market consideration. There is still the ongoing and very valid debate about whether the Fed's next move will be a rate cut or it will be a rate hike. We remain in the camp that the Fed's most realistic hawkish reaction function as the war in Iran plays out is to simply delay the resumption of normalization. And as a result, we think that the probability that the next move is going to be a rate hike is relatively low overall. That's not to say that it's an impossibility. Clearly, if hiring picks up, we see an increase in nominal wages, equities remain at record high prices, reinforcing the wealth effect, and consumers are in a position to chase inflation higher, then the Fed should reconsider its next move. However, we suspect that what is going on for the hawks within the committee is that they're attempting to incrementally tighten financial conditions via a language change as opposed to strong conviction that the next move will in fact be a hike. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as we look forward to next Friday's early close and Memorial Day weekend, we offer a nod of thanks to SIFMA for doing the right thing. And we assume that the 2 p.m. recommended close is a typo, and they really mean 10 a.m. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. so please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.